The news, the financial world, financial advisors specifically, I think do a fantastic job of making personal finance way more complicated than it needs to be. If I were to boil down what you have to do to a very simple phrase, it's simply financial discipline. If you do the basics well, that's really 95% of it. So for today's video, I just want to go over a few things that you can put in place. If you do these things, you're doing most of what you need to do. One, it's probably a phrase you've already heard, is pay yourself first. So luckily the financial world has put some instruments in place that you can maximize this concept, such as 401ks and 403bs. And what that's really saying is before you get that money in your paycheck, you can carve out a portion that's going to be set aside for retirement that you don't have to worry about, you don't have to think about, it's on autopilot. So putting a healthy percentage towards that 401k accomplishes the very simple goal of paying yourself first. Two, and one that's a little bit maybe harder to accomplish, is understand who you are financially. If you're that type of person that, whether you make $1,000 in a month or $5,000 or $10,000, all the money seems to go, you tend to like to spend. It's okay. We have to acknowledge that reality. If we do that, we can put certain things in place that deals with that reality. So for example, if you're a spender, I kind of would lean towards owning a home as opposed to renting it. The advantage of renting is, all right, I'm probably not going to have as much cost because I don't have to worry about paying for the roof or all these little, odds and ends to deal with being a homeowner, but you have to invest the difference. So if you're renting, you're not building up equity. So if you're a spender and you have that mortgage, well, that's a forced savings account. So a little bit of each mortgage payment you do is going into the equity in the home. So if we're a spender, we can, one, be putting money into a 401k, hey, out of mind. Two, I own a house, so I'm forced to be building up equity in the home. So this way, any money you do get, you can spend it because you're already having two great savings vehicles such as the home and a 401k. Three, know some reasonable metrics to benchmark yourself. So generally speaking, Fidelity did a study at around 40 years old, you should have about 3 to 4 times your salary. At 50 years old, you should probably have closer to about 6 times your salary saved up to retirement. This way, if you're saying, you're 42 years old, oh, I'm doing a great job and I'm savings at a good pace. Well, maybe you didn't start early enough in your 20s. Maybe you weren't always great at putting a pretty good percentage towards your 401k. Maybe you're a little bit behind. But if you know that, you have to play a little bit of catch up. So just knowing some basic metrics of, how much I should spend on a car based on my salary. How much of a home should I buy based on the income I have? Where should I be in terms of retirement? So knowing your basic metrics gives you a pretty good foundation of where you need to be. Another simple one is have a separate vacation fund. So I'm a big fan of having an emergency fund, 3, 4, 5 months of your fixed expenses sitting in cash, and keeping a separate vacation fund. So this way you can designate, my goal is to save $300-400 a month and at the end of the year go on a nice vacation. Well, if at the end of the year you had to dip into that vacation fund to fix this or repair that, or you spent it on this and it's not there, don't go on the vacation. Don't say, well, I've earned it, so I'm going to put it on the credit card and now I'm going to pay 20% interest. So again, some very basic disciplined approach to finance that if you rinse and repeat for long periods of time, you'll probably end up in a really good spot. If you have any questions, always feel free to give me a call.